Fund Supermart, your online gateway to unit trusts.
If we look at the region more broadly, most countries in Asia are beneficiaries of a lower oil price and lower commodity prices. The exceptions would be Australia and Malaysia, and as a result we've seen their currencies and their stock markets under pressure in the last few months. But for the consumers and the consuming countries within Asia, the lower oil price is actually quite positive, and we're certainly seeing that impact on corporate earnings growth for this year. In terms of the fund's biggest positions, we have good exposure to China, where we have a mix of the internet high growth stocks, companies like Baidu and Tencent. And in line with our process on assessing quality by return metrics and cash flow generation, these companies screen very well, and the outlook remains bright for these companies. The e-commerce market in China is very exciting and very high growth. The other major exposure that we have within the portfolio is India. We're very overweight to India. The macro environment is getting much more positive than it has been under the new leadership of Modi. He's starting to put through the much needed reforms which should stimulate the economy, offer sort of more infrastructure investment and allow a higher growth rate. But even without that sort of stimulus, we like the companies in India. We have broad exposure to financials. HDFC Bank would be good examples of financial stocks that we like in India. Then other sectors, IT services and pharmaceutical. So in IT services we have Tech Mahindra, which traditionally was more telecom focused in the work that they provided, but they are sort of gaining traction in other areas, financials particularly. And within pharmaceutical, Lupin is one of our key holdings. It's the 5th largest generics player in the US market and one of the fastest growing generics players in the US market. And again, the outlook for that company in terms of its returns and in terms of its earnings growth looks very positive. In terms of risks for the Asian market, in 2014 we've seen US dollar strength. Rather than Asian currency weakness. As I mentioned earlier, in the case of Australia and Malaysia, we've seen some currency weakness as a result of commodity or oil price reliance to the economies. But I believe that the situation in Asia now is different than it was a couple of years ago, where markets like Indonesia, India came under a lot of pressure when we saw the tapering and the expected outflows of sort of US dollar investment into the region. So I think the current account positions, the fiscal positions broadly in Asia are in better shape than they were a few years ago. And certainly when you throw in the lower oil price, that's also another key positive for the region. We are quite optimistic for the outlook on Asian equities looking into 2015. The reason being, we're back to a situation where we're seeing double-digit earnings growth. We've had 5 years or so of more sluggish earnings as we've seen cost inflation, whether that's been wage inflation, whether it's been commodity prices. And the good news this year is we have a much more positive outlook in terms of that cost inflation reducing, and that's going to be good for corporate earnings. From a macro standpoint, yes, China is slowing, but we're moving to a higher quality growth within China. And similarly, Asia, in terms of reforms, that's a key component when we look at the major markets within Asia. We've got new governments in India, in Indonesia. We've seen meaningful reform in China. It's a slow process. The second stages are SOE reform, but we've seen significant anti-corruption measures. And broadly, this is positive for the market. There is going to be some short-term pain, but in the long term, for investors, I believe these moves are quite positive.